In the early hours of January 30th, 2026, as US markets opened, the price of silver fell by $48 within just a few hours. What went largely unnoticed was that in the preceding 3 days, the CME had raised margin requirements on silver futures by a cumulative 67%, a magnitude sufficient to trigger widespread forced liquidation. Yet on that very day, as prices were being aggressively driven lower, physical refiners and bullion vaults were sending signals that pointed in the opposite direction. If this were merely a liquidation phase intended to terminate an upward trend, why did the segment of the market holding physical metal fail to behave accordingly? Immediately following the decline, the market defaulted to its familiar reflex, searching for a simple explanatory narrative. A bursting bubble, excessive speculation, capital fleeing risk. But when one pauses and observes more carefully, the most revealing evidence is not found on the price chart, but in what fails to behave like a collapsing market. Just hours before prices fell sharply, notices of temporary sales suspensions and extended delivery timelines began appearing at points in the supply chain that are most sensitive to real demand. These were not messaging decisions, but operational ones. When a refinery or distributor halts order intake, it is not because they expect prices to continue falling, but because they are no longer confident in their ability to source sufficient metal to meet delivery commitments. Such decisions are not made on sentiment. They are dictated by physical inventory constraints at that precise moment. While trading screens in New York printed successive red candles, a parallel reality was unfolding. Physical buyers did not retreat. They did not liquidate. On the contrary, they were forced to accelerate decision-making, because for them the dominant risk was not price volatility, but the possibility of being unable to secure supply at all. This divergence in behavior is where the narrative fundamentally departs from the standard interpretation. To understand this divergence, one must return to the origin of the sell-off. When margin requirements rise by 67% in a matter of days, the paper market enters a stress regime that many participants do not recognize until liquidation becomes unavoidable. Leveraged positions are no longer evaluated based on market conviction, but on the immediate availability of additional cash collateral. Selling under such conditions does not express a belief that silver has lost intrinsic value. It reflects the mechanical coercion of the financial system. This distinction is frequently overlooked, leading analysts to misattribute meaning to price movements. While paper positions were liquidated by design, physical metal remained unaffected by that logic. Silver does not disappear from the supply chain simply because futures contracts are closed. It remains in warehouses, within production pipelines, and as a non-substitutable input for multiple strategic industries. This structural reality is precisely why the price collapse failed to propagate into the physical market as many expected. The sensory shock of the event did not stem from the percentage decline itself, but from the growing dislocation. As quoted prices were pushed lower, fabrication premiums and physical spreads moved higher. This was the moment when the market ceased communicating through commentary and began communicating through behavior. When buyers accept higher costs to secure delivery, while sellers refrain from selling despite lower screen prices, that signal carries more informational weight than any verbal claim. This distinction is particularly critical for those who view silver purely as a speculative instrument. In this phase, silver was not merely reflecting investor psychology. It was revealing the intersection of monetary dynamics and industrial necessity. Production schedules cannot be halted due to short-term price fluctuations. Supply contracts are not renegotiated daily. Consequently, physical demand exhibits significant inertia, and that inertia forms a counterweight to short-term financial volatility. From a monetary perspective, the broader environment further clarifies this divergence. The US dollar remains the backbone of the global financial system, but sustaining that role amid elevated sovereign debt and rising fiscal burdens forces many actors to recalibrate asset allocation. This does not imply abandonment of the dollar, but rather the incremental accumulation of assets that carry no counterparty risk. Within such a framework, silver and gold are acquired not on the basis of price forecasts, but for their defensive monetary function. For this reason, the recent sell-off did not alter long-term buyer behavior. Instead, it exposed two market layers operating simultaneously. One layer responds to policy decisions, margin mechanics, and liquidity constraints. The other responds to inventory levels, supply chains, and delivery feasibility. When these layers diverge sufficiently, the quoted price ceases to be a complete answer to the question of what is actually occurring. The purpose of this analysis is not to declare one market correct and the other wrong, but to identify a common analytical blind spot, the assumption that paper and physical markets are one and the same. When conflated, every decline is misinterpreted as a collapse in value, and every rally is labeled a bubble. Reality is substantially more complex, and that complexity must be confronted directly. This analysis prioritizes mechanisms over emotion. The question is not whether silver will rise or fall next month, but where stress is accumulating within the pricing system. When prices are dominated by technical financial forces, while physical behavior moves independently, markets enter a phase of signal distortion. Monetary history suggests that such phases are characterized by debate and fragmentation, not consensus. From an evaluative standpoint, this event neither proves market manipulation nor invalidates the function of paper markets. It demonstrates something more fundamental. Two systems are operating under different constraints and therefore speaking different languages. Paper traders are compelled to react immediately. Physical holders operate on longer time horizons and therefore behave differently. Recognizing this distinction reduces the risk of extreme conclusions. The analytical value of viewing the event through this lens lies not in prediction, but in the capacity for multidimensional market reading. When one understands why prices can decline while physical demand remains resilient, attention shifts away from daily price fluctuations toward more relevant structural questions. Those questions form the basis for tracking gold, silver, currencies, and defensive assets in an increasingly strained economic and geopolitical environment. If one believes this divergence is merely transitory, or that paper markets continue to fully reflect underlying reality, that perspective is worth sharing. Divergent interpretations, when grounded in data and economic logic, are what make market analysis meaningful, not because they reveal the future, but because they clarify the present. And this is precisely what was missed. That sell-off did not terminate silver's advance. It exposed the boundary between two domains, one in which quoted prices respond to short-term financial pressure, and another in which physical metal flows reflect long-term monetary and economic constraints. The relevant question is no longer how much price declined, but which system is governing real behavior. When placed within the broader context of sovereign debt, monetary policy, and the historical role of gold and silver in preserving purchasing power, a familiar pattern emerges. Every episode of monetary stress is accompanied by a gradual redefinition of defensive asset value. Not abruptly, not noisily, but persistently. And this may be only the beginning. The months ahead will reveal whether markets are forced to recalibrate pricing mechanisms as pressure from supply chains, industrial demand, and fiscal dynamics continues to accumulate. Not immediately, but not indefinitely delayed. How do you believe the divergence between paper and physical markets will ultimately resolve? And what does that imply for the roles of silver, gold, and the US dollar in the period ahead? This is Money Cycles. We do not chase headlines. We examine the forces operating beneath them. And if you want to follow what unfolds next, you know where to find us.